Morning, everybody, and thanks for joining us this morning for the Q4 2025 preliminary national accounts and international accounts results for the period. We'll be taking questions at the end of today's presentation. At that stage, I'll invite people online to put your questions into the chat or to raise your hand if you'd like to ask a question. This morning's briefing will take us through the detail and some breakdowns of the key time series, to give a picture of what's happening with M&E activity in the period, and also to understand what's happening with the underlying domestic economy. The slides from the briefing will be available online along with the publications, and the press statements and contact details are available on both the publications and press release, and we do encourage you to contact us with any questions you may have. We also hope to make a recording of today's presentation available on the CSO's YouTube channel. So I'm joined this morning by my colleagues Kieran Culhana and John Sheridan, who'll take you through the Q4 national accounts and international accounts results. So I'll pass to Kieran first for the Q4 national accounts.
Thanks, Gillian. Morning, everyone. So I'll take us through our Q4 national accounts, and we'll start off looking at obviously the Q4 gives us the opportunity to see our first estimate of the year. So we'll start with provisional estimates for 2025. So our main figures here: GDP up 12.3% in the year, modified domestic demand, our domestic indicator, up 4.9%. So we look then what's driving that domestic story. We see our personal consumption up 2.9% and modified investment up 10.9%. The modified investment includes quite a lot of business investment this year. We'll go into more detail on it later, but really around that data centre sector. Back to the GDP picture, and really we've seen the story all year. The huge growth in the multinational-dominated sectors, 25.1%. That's been evident in the exports that we've seen of our trade division all year, and really has been the story of that 12.3% GDP growth. Looking down, our domestic sectors were up 0.9%, and compensation of employees up 1% in the year. So these are, of course, provisional results, and will be subject to revision when the annual results are issued in mid-year. We'll have more data then, and these are obviously derived from the sum of the 4 quarters. So if we look then at the time series, GDP and MDD, GDP, we can see that really strong growth in 2025, not quite at the level out of the pandemic in 2021, but still very large after falling in 23 and more modest growth in 24. On the MDD, in the domestic side, 4.9% growth in 2025. This is the 5th year of growth in MDD since the fall in 2020, which is, I think, positive picture. Looking down at in current market prices, which we have a level of 638.7 billion of GDP. This obviously is the figure that will be used as the denominator in any calculations as proportion or percentage of GDP. When we look then across the EU at results, we can see we're obviously an outlier in this, or with much stronger growth than the rest of the EU. There's growth across the EU, but yeah, our 12% has us well above everyone else. Looking then at the expenditure side of the annual story, and really we can see it's in that light green colour. The net exports is really what has driven that growth in the year. We also have strong increases in gross fixed capital formation, but a lot of that is driven by with large intellectual product imports in Q1 25. So looking at the elements of that expenditure method, personal consumption is up 2.9%. This is driven by services. Spending on services up 3.8%, and spending on goods up 1.5%. Really looking at in the categories, it's across the board. Really, no real element stands out in the year. Government expenditure then is up to 58.4 billion. We've seen consistent growth in government for the last number of years in government expenditure. Looking then at the composition of capital formation, we can see that yellow bar for intangibles is really the main driver of the growth in the year. Not quite as big as back in 19 or 20, but still significantly larger in 2024. So we've 42.6% growth in capital formation in the year. strong growth in building constructions up 9.1%, new dwellings up 19.4%, and all other building construction up 5.1%. The remainder of capital formations up 62.1%, with machinery equipment up 6.9%, intangibles up 34.9 billion, but excluding the R&D service imports and trade in IP, it's up 13.8 billion, giving us a modified GFCF of 10.9 billion. Now, and I suppose looking in more detail, that machinery equipment, aircraft leasing was fairly flat in the year, so that was really driven by imports and investment in computer hardware. And similarly, the intangibles figure, the domestic intangibles, has really, we've seen growth in investment in domestic software and purchases of software in the year. And this really seems to be focused mainly in the data centre sector. So if we look at the contribution then, how these elements contribute to the annual modified domestic growth, we can see that yellow bar, modified gross domestic fixed capital formation, driving the strong almost 5% growth in MDD. But we do have almost 3% growth in PCE and growth in government in the year. So on the back of, I think last week, LFS strong numbers, we ended the year with 2.83 million employed in the country. We've seen growth in COE the year, 1%. This is driven by the growth in an increase in public admin, education and health, the largest employment sector, as well as professional admin and services and industry, with some falls in distribution, transport, hotels and restaurants, and financials and information and communication sectors. Looking at the output side and the annual sector growth by share GDP and growth rate, we can see our two largest bars there, the multinational dominated sectors, industry and information and communication, significant growth of 29.1% and 11.5% respectively. And they, as you can see from the chart, they make up much more, significantly more than half of GDP in the year. Across the domestic sectors, it's a more mixed picture with, although growth in most sectors, we saw a fall in professional admin and support services of 4% and in arts, entertainment and other services. Looking more at those multinational dominated sectors, we can see information and communication has had consistent growth since 2019, whereas industry fell into 23 and 24, but has really rebounded in 2025. And we saw this again in those export numbers from pharma in particular. And again, looking at our multinational dominated sectors, it's large growth in 2025, but looking at our domestic sectors, although the growth is more modest, we have had 5 years of growth in our domestic and other sectors. So the 2025 annual summary, GDP up 12.3%. On the output side, industry up 29.1% and construction up 9.7%. Distribution, transport, hotels and restaurants up 2.1% and information and communication up 11.5%. The multinational dominated sectors up 25.1% and the domestic sectors up 0.9%. On the expenditure side, PCE up 2.9%, government expenditure up 4.1%, investment up 42.6% with modified investment up 10.9%, net exports up 22.9 billion. Final domestic demand then up 15.2% and our modified domestic demand up 4.9%. The net factor outflows, an increase from 134 billion to 191 billion. I think John will have more information on that in the international accounts, but that gives us a GNP figure for the year of 2.4% and COE up 1%. And a reminder again, these are provisional figures. We will revise them again mid-year when we have full annual data. And we use our full annual process rather than the sum of the 4 quarters. Turning now to our results for quarter 4, and our headline figure is a decrease quarter on quarter, seasonally adjusted of 3.8% in GDP, with modified domestic demand up 1% in the quarter. So I think if we look along the top line there on our output side, we see a decrease in industry really driving that decrease in GDP. Information and communication remains strong growth at 4.5%, with a more mixed picture on the domestic side with distribution, hotels, transport, professional admin and support and financial and insurance services all up, construction down 3%. Then on expenditure and what's driving that, really it's the personal consumption's up, government expenditure's up, but we see a large decrease in investment and then decrease in export and imports, which give us a decrease in net exports of 9% in the quarter, which is really driving that decrease in GDP. On the domestic side, personal consumption and government expenditure and modified investment is up 1.8%. So that gives us our MDD for the quarter of 1%. Where this is coming from, I suppose, we look at some of the short-term indicators published by the CSO and our enterprise division. We look at industrial production, the December results. You can see that if we look at that modern sector, which really is our multinational dominated sector, we can see the level is still well above what was there in 2024, but it doesn't have those. We didn't have those spikes that we saw in quarter 1, 2 and 3 that were bringing up production in those quarters. And again, in our trade numbers from our trade division, again, exports in the quarter, October, November, December, they're below the levels they were in 2024 and a long way below what the exports we saw in quarter 1, 2 and 3. And that really is, that story, that explains that fall off in quarter 4 of the 3.8% GDP. So looking at the time series then, GDP down 3.8%. I think the real story there is that significant increase out of 2024 and into quarter 1 2025 levelled off in quarter 2 and quarter 3, and now we have a smaller decrease in quarter 4. And again, MDD, we've had 4 quarters of positive growth in the year. This is, as you're probably all aware, this is our second estimate of quarter 4 growth. After 30 days, we published our preliminary estimate, and it was minus 9.6% or 0.6%, which we have revised down to minus 3.8%. As we explained at the time, this is a frontier release. It has incomplete data and uses new data methodologies. Now we have our enhanced data sources. We have full 3 months of those short-term indicators. We have company data for the full quarter, and that gives us a better estimate of what's happening in quarter 4. We also were able to do an expenditure as well as an output method, and we obviously seasonally adjust the full series again with the additional quarter. So again, unlike with the opposite picture in quarter 4 to the picture for the annual, when we look at across Europe, we're now at the left with the largest fall in GDP in the quarter, where most of the EU had some small but positive growth. Looking again at the trends in sector growth, and we see the really story this quarter, a small fall off in that trend in growth in industry, whereas information and communication continues to grow quarter on quarter. In our domestic sectors, we see that more mixed picture with fall in construction after strong growth earlier in the year, with an increase in distribution, transport, hotels and restaurants, and professional admin and support services in the quarter, and a more level story in public admin, education and health. So looking at compensation employees, quarter 4 2025, and COE is up 1%, again driven really by increases in the largest employment sector, public admin, education and health, as well as industry, with some falls in distribution, hotels and restaurants and professional admin services. If we look a bit more detail at what I suppose this constant COE series is telling us as a labour input volume method, and we see that it's driven strongly by changes in hours worked. So increases in employment and increases hours work will increase our COE at constant prices. But that small gap is really down to compositional changes as people move jobs from lower paid sectors to higher paid sectors. Looking then at the expenditure side, and the fall off in growth, again, is the light green colour, or net exports, really driving the fall in GDP on the expenditure side this quarter. When we take out the globalised elements, the exports, the stocks and the imports and exports of IP and aircraft leasing, we see modified domestic demand, and it's really driven 1% growth by small growth in the 3 expenditure areas: PCE, government expenditure and gross fixed capital formation. So as I said, PCE is up 0.9%, with services up 1.1% and goods up 0.5%. When we compare household expenditure then across Europe, we can see we're no longer an outlier, and we fit in more with the average for the rest of the continent, or the EU. Looking at government expenditure data, up quarter on quarter, constant price seasonally adjusted, and I think that we can see this driven really by an increase of 10% voted current expenditure quarter on quarter. Now, these are on different bases, constant prices and current prices, but it is reflected in that government expenditure number. Compensation, we look in more detail now at our capital formation, and again, it's a small decrease really and really driven by a small decrease in that yellow intangibles bar. So it's down 4.6% quarter on quarter seasonally adjusted. Building and construction's up 1%. Machinery equipment up 7.9%. Intangibles down 2.1 billion. Machinery equipment excluding aircraft leasing up 23%. Again, that's driven by investment in computer hardware. Intangibles excluding R&D service, imports and trade and IP down 16%. But we did see our investment in software hold up, and it was a change in domestic R&D really driven by increases in R&D service imports and exports that are giving us that negative 16%. But we have a modified GFCF in the quarter of 1.8%, which we see now how that contributes to the quarterly MDD growth, and really PCE is the largest driver of it this quarter. But again, there's positive growth in the three elements, all around that 1%. Making the walk then from GDP to GNP, net factor flows, we see a decrease in net factor flows quarter on quarter from 46 billion to 37 billion, which gives us our GDP number of, of 3.5, or GNP number, of 3.5% in the quarter. So if we look then at the price effects, and I suppose it's important to keep an eye on prices, and when we look, I guess, at what's happening, the situation in the Middle East, etc., we might see prices have a greater effect on our economy in the next while. Seeing GDP, current prices are up 1.3%, and constant prices up 2.2% year on year, which gives an implied price deflator of minus 0.9%. And on the consumption side, current prices up 4.7%, constant prices it's up 2.6%, giving an implied deflator of plus 2.1%. And these really in line with the numbers we see from our prices division, where the wholesale price index was down around 5% in the quarter, and the consumer price index up 3%. So to summarise quarter 4 2025, GDP is down 3.8% in the quarter. On the output side, industry down 3.6%, information and communication up 4.5%, construction down 3%, and distribution, transport, hotels and restaurants up 3.8%. The multinational-dominated sector is down 2.6%, and the domestic and other sectors up 1.6%. On the expenditure side, PCE is up 0.9%, government expenditure up 0.3%, investment down 4.6%, but modified investment up 1.8%. The net exports are down 5.4 billion. So final domestic demand down 1.2%, and modified domestic demand up 1%. The net factor outflows have reduced from 46.7 billion to 37.1 billion, giving us a positive GNP of 3.5% growth in the quarter, and COE, or the wages, up 1.1%. Thanks. I'll pass you over now to John for our international accounts.
Thanks, Kieran. So now I'd like to take you through the international accounts for quarter 4 2025. Apologies. So first we can see our infographic, which gives a good summary of the results. So we have our goods exports at 88 billion euros and imports of 46 billion euros, giving us net merchandise balance of 42.2 billion euros. Our services exports are 138 billion and imports 130 billion, giving us a services balance of 8.1 billion. Income inflows were 79 billion euros and outflows 117 billion euros, giving us net income outflows of 37.5 billion euros. And these all combined to give us our current account balance of 12.8 billion euros, which is 8.4% of GDP. Our net international investment position stood at minus 304 billion euros at the end of December, and our stock of foreign direct investment in Ireland was just over 1 trillion euros. Looking at the preliminary results for the year 2025, we can see our merchandise surplus has gone from 157 billion in 23 up to 176 billion in 24, and then up to the 230 billion we see in 2025, which is an increase of 54.7 billion euros on the previous year. Our services balance has gone from 17 billion in 23 to 60 billion in 24 to 26 billion in 25, with the differences here largely driven by the fact that we had large IP exports in 24, which will push up our services balance. Our net income outflows moved from 138 billion in 23 to 144 billion in 24 to 204.5 billion in 25, with this largely reflecting the increase in merchandise that we're seeing. This is an increase of 60.2 billion euros on the previous year, and within this, we have an increase in our manufacturing outflows of 68 billion euros. And these all combine to give us a current account balance of 52.1 billion euros, which is down 38.9 on last year. And again, this change is largely driven by the high level of IP exports in 24 that weren't present in 25. Looking at our current account balance as a percentage of GDP, we can see the fluctuations caused by large levels of IP imports and exports in Q1 24, Q3 24, and Q1 25. But we're back to a more usual level now this quarter, with our current account balance at 12.8 billion euros, or 8.4% of GDP. Looking at our current account balance over time, we can see that the current account balance has decreased from 18.2 billion euros in Q4 24 to 12.8 in Q4 25. And this is a decrease of 5.3 billion year on year. And compared to the last quarter, this current account balance is down by 1.1 billion. The merchandise surplus has decreased by 55 billion this time last year to 42.2 billion in Q4 25, a decrease of 12.8 billion year on year. And compared to last quarter, our merchandise balance was down by 13.2 billion. But it's important to remember that for the year as a whole, the merchandise balance is still much higher than it was in 24. The services balance is up from 6.9 billion in Q4 24 to 8.1 billion in Q4 25, an increase of 1.2 billion year on year. And our net income outflows have shrunk from 43.7 billion this time last year to 37.5 billion this quarter, a decrease of net income outflows of 6.2 billion euros. But again, while we can see the decrease this quarter, we can see that overall for the year, it is greatly increased compared to 2024. Looking at this in a little more detail, we can see that our merchandise exports at 87 billion euros are down 4.4 billion on the same quarter last year, while our imports at 45.6 are up 8.4 billion, giving us a net decrease of 12.8 billion euros. Service exports are 138.1 billion, up 10.2 billion, and imports are 130, up 9 billion, giving us an increase in the services balance of 1.2 billion. Primary income inflows at 76.9 billion are up 2.3 billion on last year, while outflows of 113.3 billion are down 3.8 billion on last year. And these give us a net change in our primary income outflows of 6.1 billion. And we can see, looking at the direct investment profit and interest inflows and outflows, that they make up about half of the increase in inflows and about half of the decrease in outflows. Looking at our goods imports and exports a bit more closely, we can see that our Q4 goods exports are down strongly compared to last year and also down compared to last quarter. But this is coming off the large levels we've seen in Q1, 2 and 3 this year. So this, while our goods imports are up both compared to last quarter and last year, and it's this combination of decreased exports and increased imports that is driving the changes in our merchandise balance year on year. Looking at the breakdown of BOP merchandise, the decrease in net exports is driven by a reduction in exports across international trade and goods for processing, which is partially balanced by an increase in merchanting. And these combined with the increase in imports in international trade and goods for processing are driving an overall decrease in the merchandise balance year on year of 12.8 billion euros. The decrease in the merchandise balance of 13.2 billion quarter on quarter, however, is driven by the international goods exports, which are down 12.5 billion compared to last quarter, and the other adjustments. These are partially balanced by an increase in merchanting this quarter. Looking at our service exports compared to the same quarter last year, we can see an overall increase of 10.2 billion, and this is largely driven by increase in computer services, which are up 5.5 billion. Financial services are up 1 billion, and business services are up 1.7 billion. And within that, operational leasing has increased by 1.1 billion. Tourism service exports are up 145 million, while transport service exports are up 89 million. Looking at the import side, we see year on year we have an overall increase of 9 billion euros. And this is largely driven by increase in business services, which are up 4.1 billion, and royalties, which are up 3 billion. And we also have financial services up 1.1 billion. Looking a bit more closely at the royalties, the blue line here gives us the total royalty imports, which have increased 3 billion compared to last year and 6.5 billion compared to last quarter. The green bar gives us the amount of royalty imports related to the pharma sector, which are down 1.8 billion compared to last year and up 1.2 billion compared to last quarter. So the main driver of increase in royalty imports, both year on year and quarter on quarter, is the ICT sector, which makes up the vast majority of that yellow bar, which is the difference between the pharmaceutical and the total royalty imports. Looking at our direct investment income, we have inflows of 24.6 billion euros, which are up 1.6 billion compared to last year and 5.1 billion on last quarter. Outflows are 63 billion, down 1.7 billion on last year and 3.7 billion on last quarter. And this gives us net direct investment income outflows of 38.5 billion, down 3.2 billion on last year and 8.9 billion on last quarter. Looking at how these break out, our income on debt, seen here in navy, is fairly flat as usual. A decrease in dividends and an increase in reinvested earnings, when combined, give us an overall decrease in outflows, both year on year and quarter on quarter. Looking at how these profits break down by sector, quarter on quarter, we see a decrease in the manufacturing sector, which is down 4.2 billion, whereas the information and communication sector is up 413 million on last quarter. But looking at this year on year, we see the opposite picture, with the manufacturing sector up 3.5 billion, while the information and communication sector is down 1.5 billion. Looking at our financial accounts, we have large gross transactions across most functional categories, with smaller net effects. So in direct investment, we have net transactions of 18.6 billion, and this is made up of direct investment in Ireland, which increased by 10.8, and direct investment abroad, which increased by 29.4. In portfolio investment, we have net transactions of minus 7.5 billion, and in other investment, we have net transactions of minus 2.3 billion. Next, we turn to the international investment position. The IIP is the stock of assets and liabilities that Irish residents hold in or owe to other countries. And the difference between the assets and liabilities is the net IIP, which represents either a net claim if positive or a net liability if negative to the rest of the world. And just to note, the navy bar visible here represents direct investment, while reserve assets are barely visible in the graph. The net IIP stood at minus 303.6 billion at the end of December 25, which is an increase of 26.2 billion on the end of September 25. This increase is driven by changes in non-financial corporations and general government. Following our publication in July, we continue to include the IIP breakdown into foreign and domestic control to further showcase the large levels of multinational activity of foreign controlled corporations in Ireland. The foreign-owned net IIP, which is the navy bar, stood at minus 514 billion at the end of December, while the Irish-owned net IIP stood at plus 210 billion. There are further breakdowns by institutional sector and functional category in the publication. Looking now at accounts with the US, we first present the current account, which covers merchandise, services and income. Year on year, the current account deficit, the navy line, has grown by 15.9 billion compared to the same quarter last year and grown by 31.1 billion compared to last quarter, bringing the current account deficit with the US to 70.4 billion euros. Within this, the merchandise balance has decreased by 1.3 billion compared to last year and 13.8 billion compared to last quarter. The net services deficit has grown by 8.7 billion to 54.8 compared to last year, which is an increase of 5 billion on last quarter. And our net income outflows have increased by 6 billion compared with last year and 12.3 billion compared to last quarter. So as is reflected in the graph, we have a positive merchandise balance, which is offset by negative services balances and negative net income, resulting in a current account deficit of 70.4 billion in Q4 25. Looking at our international investment position with the US, just like the current account, this is where we look at the geography of the immediate counterpart. And so we can see positions in net direct investment in navy, portfolio investment in green, and other investment in yellow. Again, reserve assets are barely visible. At the end of Q4 25, Ireland's net international investment position with the US stood at 1.3 trillion euros, down 94 billion from the previous quarter. So just to summarise, we have a current account balance in Q4 25 of 12.8 billion euros or 8.4% of GDP. We have merchandise exports that are down strongly compared to last quarter and last year, but again, the total exports for 25 are higher than for 24. We also have increased computer service exports and royalty imports compared to last year. So now I'd like to pass you to Gillian to summarise the results.
Thanks, John. So just to summarise those headline results again, for quarter four, we see that GDP is down 3.8%, with modified domestic demand up 1%, personal consumption expenditure up 0.9%, and modified investment up by 1.8%. And the M&E dominated sector, we see that negative growth of minus 2.6%, while the domestic sectors had positive growth of 1.6% and compensation of employees up by 1%. Then that provisional look at the year by summing the 4 quarters, we have a GDP result of plus 12.3%, modified domestic demand up 4.9%, with personal consumption expenditure up 2.9%, and modified investment up by 10.9%. The M&E dominated sectors have growth of 21.5%, while the domestic sectors are at 0.9%, with compensation of employees for the year up by 1%.